for insight. Let's go to our featured guest of the morning. He's Greg Newman, Senior Wealth Advisor at Scotia Wealth Management and a frequent guest on this program. Thanks for coming in. Great to see you.
Thank you very much. Great to be here.
Let me tell viewers a few more facts about this deal. Here are the basic deal parameters. The companies describe it as a merger. It is, however, a purchase really by Exxon-Mobil of Pioneer Natural Resources. It's an all-stock transaction as well. Total value, as we told you in our newscast, $59.5 billion in deal value. Specifically, about 2 1/3 Exxon shares are swapped for every 1 share of Pioneer, and that comes at an 18% premium to the value of the unaffected Pioneer share price. That's the share price of Pioneer earlier this month, before rumors began to emerge that this deal was in the works. The result will be an ExxonMobil that has this 16 billion barrels of undrilled and unextracted resources in the Permian Basin. ExxonMobil's Permian production will be 1.3 million barrels per day. That's a big, big number from the Permian Basin, a region that the super majors have largely avoided until now, and it will more than double the current Permian output of Exxon Resources. What are some of your initial thoughts, Greg?
My initial thoughts are that they are looking to take, post-close, about 1.3 million of production in the Permian to about 2 million by 2027. So my initial thoughts are that's a lot of growth. And what, North American producers have been talking about for a long time is pricing discipline.
Right.
Not growth at all costs.
Right.
I wonder I think this is a very big deal for the oil markets, because I think these guys can act more of a swing than presently is happening. And I think it can help lead to more reasonable oil prices.
The company being acquired, Pioneer, was a leader in the Permian Basin. Its chief executive officer largely credited for making the U.S. an oil exporting power through the remarkable production of shale oil and gas in the Permian region. What's this saying, if anything, about the sector as a whole, Greg? Oil prices are high. There's a lot of positive sentiment around these companies and around these stocks. Is this the type of environment that makes it easier to get a massive deal like this completed?
Well, I think what it means is the Permian has been the domain of fragmented companies.
Right.
And I think that this means you're going to probably see more consolidation. So that could be good for shareholders of these companies. I think that this is a very pro-North American, pro-U.S. deal in trying to have more control of the price of the commodity. So I think that it's probably positive, and I think that the deal will probably get done and endorsed by regulators.
That was my other question. Joe Biden, the president, has criticized the levels of profitability at ExxonMobil in the fairly recent past. The U.S. president always has to be aware of gasoline prices. You think this will get green-lighted by regulators?
Well, I think their timing is good right now with the particular backdrop. So yes, I do think that this is a good time for them.
Last question. What type of position in your portfolios for clients do you have in this sector?
So oils, it really depends on how much risk and how much equity exposure. For some clients, we have as little as 4%, and for some, we have as much as 9 or 10%.
Okay, that's great.